Hello everyone, my name is Nathan Corroy. I'm the Director of Financial Planning here at Richardson Financial Group, and today I'm joined with Dan Brown, our Director of Investment Management, and we are here for the July 2022 Investment and Economic Update. After a challenging first 6 months of the year with pretty much all asset classes and sectors sharply negative through the end of June, investors finally felt a bit of reprieve in the month of July with some strong positive performance. To start with, do you want to give us just a quick recap on what we saw in the markets in the month of July and what were some of the catalysts that drove that performance?
Sure, Nathan. So as you mentioned, very rough first half of the year. Stock market down considerably, especially in the month of June. So that presented very cheap valuations for investors in July, and it appears as though investors reacted to that. And then some of the catalysts were second quarter earnings season is starting off very strong. So I think a lot of investors were concerned about second quarter earnings, thinking that they would need to come down considerably due to the fact that inflation is at a 40-year high, and that would impact their bottom line. But so far, about 1/3 of the way through earnings season, that doesn't appear to be the case. And another catalyst was late in the month, we saw the Federal Reserve actually raise interest rates, but investors reacted positively to that because they heard from the Federal Reserve, specifically from Fed Chairman Jerome Powell, that the Fed could pull back on their pace of future interest rate increases, and that reassured investors. So again, very strong July for performance, both for stocks and bonds. In fact, the stock market, S&P up over 9%, and one of the strongest months since late 2020.
So Dan, as you noted, a key driver for the performance in the month of July was the release of earnings from companies that came in a little bit stronger than maybe had been expected. Do you want to give a little bit more color on what we saw on that front?
Yeah, Nathan. So I think going into second quarter earnings season, investors were a little bit nervous and on edge, thinking that companies would have to lower earnings expectations due to the fact that, again, costs are running at a 40-year high with inflation. And so far, we haven't seen that with second quarter earnings season. So very encouraged on that front. Underlying demand trends, so on the revenue line, continue to be very strong. But with that all said, we wouldn't be surprised if earnings expectations for maybe third quarter and fourth quarter or early 2023 need to come down a little bit due to the fact that inflation is running at a 40-year high, and we're starting to see some cautious signals from companies, pulling back on spending.
So Dan, one of the key issues you mentioned were the actions taken by the Federal Reserve and Chairman Powell. And we saw late in the month of July at the Fed meeting, we had another increase in that Fed funds rate, which brought it up another 75 basis points to that target range of 2.25 to 2.5. How did that rate increase match market expectations, and kind of how should we think about that going forward through the rest of the year?
Sure, Nathan. So the Fed meeting and the actions met investor expectations of the 75 basis point rate increase from the Federal Reserve. And the real action from that meeting was during the press conference when Fed Chairman Jerome Powell strongly hinted that with the growth slowdown we're seeing in economic activity, that the Fed could slow down the pace of future rate increases. And that's what the market reacted so strongly to late in the month. So we saw a really strong rally to end the month of July.
So Dan, shortly after that Fed meeting we had at the end of July, we got the results of the second quarter GDP, which showed a slight negative print, which was the second quarter in a row. Do you want to give a little bit more color on kind of what implications that has for the markets? And I know the word recession gets thrown around a lot, and it's the question of whether or not we're in or heading to a recession and what that means for investors.
Sure, Nathan. So as you mentioned, second consecutive quarter of negative GDP, which many people consider to be a recession. Just want to remind investors, but that is just a broad rule of thumb. And the official arbiter of a recession is the National Bureau of Economic Research, and they have yet to come out and say that we're in a recession. And from our point of view, it's a little bit tough to say we're in a recession right now. We fully acknowledge the 2 quarters of negative GDP growth, but with the employment situation as strong as it is, which is one of the considerations that they take into effect when determining if we're in a recession, very strong on that front. So if you look at unemployment rate, below 4%, still plenty of job openings. It's kind of tough for us to say we're in a recession, but more importantly, we're paying attention to the financial markets and how they're reacting.
So Dan, it sounds like despite the challenging environment we've seen overall this year, we've got a few positive catalysts that have boosted the performance of the markets in July. How should we think about things going forward, and what should we expect to see for the rest of the year?
Yeah, Nathan. So again, we're wrapping up second quarter earnings season. If the remaining, 2/3 is like the first third, it should be pretty strong. But we wouldn't be surprised if earnings expectations in the second half of the year start to come down. But so far, again, very encouraged by the fact that corporations are dealing with the higher inflation. And on the inflation front, we would expect it to roll over here in the near future. So we've seen commodity prices, for example, roll over pretty hard here the last month or so. So we would expect inflation to trend lower here in the second half of the year, which hopefully should lead to the Fed backing off with their aggressive pace of tightening monetary conditions.
Great, Dan. Thanks for sharing your insights today, and obviously thank all of you for watching. If you found the video to be helpful, feel free to hit the like and subscribe button. Thanks again for watching, and we'll see you again next month.